When a trader clicks buy and the screen flashes green, the transaction feels complete, but that split-second digital confirmation on an exchange floor is only the beginning. It is merely a signal. The actual transfer of legal ownership has not yet occurred. Moving billions of dollars between counterparties without triggering a market failure requires a highly regulated, tightly orchestrated operational pipeline working entirely behind the scenes. At the core of this pipeline is the concept of title, the definitive legal proof of ownership. For centuries, proving title meant holding a physical object. Investors once relied on physical paper stock certificates. Your name printed on the page, or simply your possession of the document, served as your undeniable claim to a share of a company. Under a system known as bearer shares, ownership belonged entirely to whoever held the physical paper. If you wanted to sell, you handed the certificate to the buyer. The physical transfer was the settlement. But paper is vulnerable. A lost certificate meant lost wealth. More critically for regulators, physical transfer offered total anonymity, creating massive loopholes for tax evasion and money laundering. As a result, authorities have largely immobilized or completely phased out bearer shares. The physical reality of moving paper certificates across borders could not support a global financial system executing millions of trades a second. The market required a total architectural redesign. The solution was dematerialization. Physical certificates were destroyed or locked in permanent vaults, replaced entirely by digital records. Today, securities are issued in registered form on a non-certificated basis. Your ownership exists purely as a verified line of data on an electronic register. To manage this immense volume of data, markets rely on a central securities depository, or CSD. This institution maintains the master ledger for these electronic records. When shares change hands, nothing physically moves. The CSD updates its electronic ledger, debiting the seller's account and crediting the buyer's through a secure book entry transfer. Stripping away the physical constraints of paper allows trades that once took weeks to process via courier to finalize in a matter of days. Reducing an asset to a verified data point inside a centralized digital vault eliminated the physical friction of trade. With ownership secured electronically, the market could construct a specialized engine to handle the actual exchange of cash for these assets. When a trade executes, the agreement locks in instantly. However, the exchange of cash for shares, the actual settlement, usually takes 1 to 2 business days, a delay known as T+1 or T+2. The window between execution and settlement is governed by clearing. This is the stage where the exact legal obligations of the buyer and seller are formalized, trade details are matched, and collateral margins are calculated. Historically, clearing and settlement occurred directly between the two trading parties, a model known as bilateral settlement. This creates direct counterparty credit risk. If Firm A agrees to buy shares from Firm B, they are financially exposed. Should Firm B go bankrupt during that brief T+2 window before delivering the cash or the stock, Firm A faces an immediate, unexpected loss. Major financial institutions hold thousands of bilateral contracts simultaneously. A single default triggers a domino effect. One firm's failure leaves counterparties unpaid, causing them to default on their own obligations, infecting the broader market. Scaling global markets to handle trillions of dollars daily meant this web of direct firm-to-firm default risk had to be neutralized. The entire system desperately required a structural firewall.
That firewall is the Central Counterparty, or CCP. The CCP inserts itself directly into the middle of the trade, severing the fragile bilateral connection between buyer and seller. Through a strict legal process called novation, the CCP becomes the buyer to every seller and the seller to every buyer. The original trading parties no longer interact with each other. They interact only with the CCP. This architecture mutualizes systemic risk. The burden of default shifts from individual vulnerable firms to a highly monitored, heavily collateralized central entity designed specifically to absorb financial shocks. With the legal obligations secured by the CCP, the transaction moves to its final phase, settlement. To ensure neither party is left empty-handed, settlement engines utilize a strict protocol called delivery versus payment. The buyer's cash and the seller's stock move at the exact same moment. If the buyer does not have the funds, the system blocks the delivery of the stock. By forcing the simultaneous exchange of stock and cash, delivery versus payment eliminates principal risk.
The settlement engine operates as an institutional quarantine, structurally isolating the global market ecosystem from the lethal threat of an individual firm's collapse. Once settlement is complete and a security rests safely in a portfolio, the process continues. Financial assets are not static objects. They undergo structural mutations over their lifespan. These mutations are called corporate actions. They are events initiated by the issuing company that reconfigure the physical shape, quantity, or underlying value of the securities held by investors. Operations process over 150 corporate actions, classified by the intervention required. A mandatory action is ordered by the company's board and requires zero investor intervention. It is applied automatically to the ledger. A common example is a consolidation or reverse stock split. In a 1-for-4 consolidation, the company decreases its number of issued securities. Every 4 shares held by an investor are consolidated into a single new share. The total share count shrinks, driving up the nominal value of the remaining shares. Another common mandatory event is the final redemption of a debt security, where a bond reaches its maturity date and the issuer automatically repays the principal to the bondholders. These mandatory actions highlight the operational power of a dematerialized ledger. Issuers force mathematical updates across millions of individual portfolios simultaneously, without asking for permission. The second category is mandatory with options. A default action executes unless the shareholder intervenes before a deadline. In a rights issue, investors are offered additional discounted shares. They must actively choose to participate. If they do nothing, their rights simply lapse. Finally, there are voluntary corporate actions. These events mandate nothing by default. They strictly require an active, conscious decision from the shareholder to participate. If an external corporation launches a takeover bid, each individual shareholder must independently review the offer and choose whether to tender their shares. If they ignore it, their position remains unchanged. From the chaotic floor of the exchange to the rigid binary logic of a corporate action, the full architecture of the market relies on an exact sequence of events. Modern investment operations transform abstract trade agreements into legal certainty through delivery versus payment. They insulate the global network from collapse through CCP novation, and they maintain the mathematical reality of assets through automated corporate actions. The market functions precisely because of the machinery operating beneath it.